how do you evaluate deals that you would personally lend on?
I was a private money lender before I started raising capital. I'm going to give you two key things. Loan to own. Don't lend on a deal if you're not willing to own it if the deal goes south. Second thing, holding more collateral than your loan is worth. Okay, you have a fix and flip. Well, I don't know how to underwrite. I don't really know if it's that great of a deal. But if I can hold your two houses that are cash flowing, if your fix and flip flops, I just basically inherit your two cash flowing properties. So my collateral is worth more than my loan. So finding the right people or partners or who to learn from is more important than the deal itself. Because if you find the people that have a track record, you're going to have more success than being like, oh, those look like good numbers, but this is your first deal and you're poor.
Why mobile home parks? What's the market trend and what's the outlook for this asset class?
The benefits with mobile home parks are, first, we are updating the amenities of the parks when we go in. This is helping the tenants, but also investors building the equity of a park. So then when we resell it, there's a high margin there. And average home is worth around, you can get a house for around $400,000. And a mobile home, you can get one anywhere from $35,000 to $45,000. You're going to look at rent rates for a 2-bedroom, 1-bathroom. Average rent is $2,000. If you're going to rent a unit to park your house on in a mobile home park, market rent is $500. Apartments can raise their rents because of high demand. What about those people that can't afford those apartments? So the people that are getting pushed out of their homes and they have to rent, we're providing a position for those people to go into mobile home parks.
Can you share a little bit about the project? Like what's your purchase price? What's your renovations, expected expenses, and your expected cash flow?
So purchased it for $2 million. And I'm raising $2 million, and we're also buying it for $2 million. The money that I'm raising for $2 million, $500,000 is for the down payment. And then the seller is carrying $1.5 million, 6% interest only payments for 5 years. Now, the $2 million that I'm raising capital for, in a nutshell, $500,000 for the down payment, $1 million is going towards purchasing those 40 modular homes. $425,000 is going to updating the amenities, filling the potholes, the landscaping. We put up pavilions and dog parks and barbecues and park benches, solar panel light posts. So that's where the $425K goes. And then the $75K are for closing costs. So remember on that park that I'm currently working on at $390 a month is what they're paying. So if you times that by 60 units, that's a decent number. Now let's take 102 units and times that by $500. Your cash value after expenses currently is $183,000. By year 5, raising rents and selling those homes, it's around $325,000 cash flowing every year. It will make $580,000 a year, but after expenses, it cash flows solidly over $300,000 yearly. And remember, we don't have a lot of overhead. We don't have a lot of turnover. People stay in there for 14 years. We just have a couple landscapers and someone watching over the management.
Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Today, we have Jill Jensen. She is one of the leaders in the subject community. And just to give you a little bit of background, I mean, she is an entrepreneur force. She's been shaping the landscape of sales since 2010. And she started her journey in real estate in 2022 when she started investing in mobile home parks and directing her capital towards funds for multifamily properties, which I regard to as the big leagues. So right now, Jill is the chief investment officer at Sonos Capital, and she's is an expert in raising capital and teaching others how to raise capital for mobile home parks. In her early 20s, she started her own pest control company. She expanded nationwide, generating multiple $1 million annually. Wild, right, everybody? I told you we got a heavy hitter, and I'm so excited for this. I mean, she's a dedicated single mom to two little girls. She's a driven visionary, and she is so committed to making a lasting impact in all those that she does the business with. So that's why I'm so excited to bring her onto the show and share with all of you. Jill, how are you doing today?
Kent, thank you, first of all, for letting me come on your show. And I'm just living the dream.
Jill, when I first heard your name being mentioned on the Zoom and how you were interviewed about lending and analyzing deals and teaching people how to be what I would call is, if there is such a thing as a word, safe in investing, you were teaching such great skills. And I really, really resonate with that because everybody is just so hungry for a deal that sometimes they get blinded and not do the right steps or take the right amount of due diligence for deals. So I appreciate you so much in your leadership and your expertise in that you're sharing with the world.
Thank you. That's what I really do enjoy, not just helping other investors, but helping other people help their investors do the same thing. So I've seen a lot of deals go south, not personally. I've never lost any money or had a deal go sideways. So we can dive into that as well.
Well, maybe for today's conversation, I know you're in mobile home parks and we never had a mobile home park investor on this call yet. So you're going to be setting a really high bar for people.
Okay.
And then let's go into maybe how you lend on more private deals, because on this podcast, we have folks that are single family investors looking for private money lenders as well, all the way to apartments, multifamily, and ground up construction developers. So I think it's really cool that we brought you on for mobile home parks, and maybe just help us understand, like, why mobile home parks and what's currently going on in that asset class? What's the market trend and what's the outlook for this asset class?
That is a great question, Kent. And when I got into real estate, it was kind of like, okay, how do people make money in this? And I skipped the single family and I'm like, okay, I'm just going to go down multifamily. Let's just find the people who are already successful at it and follow their lead. And so some of my relationships have really formed in regards to finding the right who's, not just figuring out how to do it. So the benefits with mobile home parks are, there's three things. First, we are updating the amenities of the parks when we go in. And this is helping the tenants, but also investors building the equity of a park. And so then when we resell it, there's a high margin there. And when you look at the market, we're going to look at some numbers. So a home, average home is worth around, you can get a house for around $400,000. And on a mobile home, you can get one anywhere from $35,000 to $45,000. You're going to look at rent rates. For a 2-bedroom, 1-bathroom, average rent is $2,000. If you're going to rent a unit to park your house on in a mobile home park, market rent is $500. So the people that are getting pushed out of their homes and they have to rent, apartments can raise their rents because of high demand. Well, what about those people that can't afford those apartments? We're providing a position for those people to go into mobile home parks. So high demand. As investors, there's low overhead and there's great margin for making a profit on them.
I really loved how you explained that, Joe, because I don't think I ever thought about the process of, okay, I can go buy a $400,000 home or I could go buy 35 to 45 grand. Granted, I'm still paying $500 to rent the pad, but that seems a lot more affordable than the $2,000 a month. And sometimes people just regard $5 as an HOA fee sometimes, right? So that's a great comparison and a great way to explain why the value proposition is there for a mobile home park. And you're the expert here, and you and your team are in the space already. For those people that are looking to get into mobile home parks, what are the key factors that they should focus on whenever they're looking for a mobile home park to invest in?
Kent, that's like a perfect question. There's two avenues. First, we're going to look at money and numbers. And second, we're going to look at the park itself. And so a lot of these parks were built in the 50s. And that's important to know because a lot of the people that had developed them have still held on to them. And now they're all in their 80s. And when you say, hey, let me look at your books to see if I want to buy this, they usually hand you something like this or a napkin or something. So we pride ourselves. It's really important to know how to like dissect. And some of those things are being able to go into the park, seeing, okay, does this have a well or a septic tank? I just got off the phone with a gentleman who wants to sell his property. And I'm going to give you an example of a deal we don't like. And it's a 16 units. So we like larger amount of units. And has a well and a septic tank, and they're all park owned homes. So he's renting the homes. Our model is we want quality parks, but higher quantity of units. So the current park that I'm raising capital for is 102 units. We have regular water, power, and less overhead. And the reason I say less overhead is because we sell all of the homes. So we just own a expensive parking lot is kind of a good concept. All 100 homes are going to be sitting on these units. We're not filling tenants. We're not fixing toilets. We're collecting $550 on 101 units every month.
What a great analogy to say that this is an expensive parking lot, because that is so much more relatable to people, especially when they think about investors like, oh, what am I buying? Am I buying this big building? But everybody has gone or come across a parking lot in their life before.
Yeah.
And they're like, oh, like, especially if you're in a big expensive city. I grew up in Boston. I heard people selling parking spots for hundreds of thousands of dollars. And I was just thinking, oh, that's so wild. But now that you mention it and how you compare this, that makes a lot of sense. When you are just renting out the spaces, then what kind of expenses do you even have anymore then?
We pay someone in the park to oversee it. It's usually someone that lives there. So we give them free rent and we pay them a little bit of like a salary or something. And so there's not a lot of overhead. As we grow bigger or fill up those units, we do have people that help with the maintenance. So landscaping, if there's potholes that need to be fixed, if a mailbox gets hit or a light post goes out there, but it's considering an apartment complex, very minimum overhead. So some things else that we look at, and like I mentioned, when you get these books, you have to be able to drive in there and see, okay, I got to measure this unit, kind of like your parking stall, and be like, okay, I can fit a 2-bedroom, 1 bathroom, and a double wide or whatever. So I have to be able to calculate it myself, see the potholes, estimate how much that's going to cost, go off the comps and knowing what they are. So now we're going to shift and look at numbers. And how do you determine if it's a good deal based off of their finances? So we go off of their taxes and their bank statements when they don't have a good bookkeeper. And if you purchase a home for, let's just say $300,000 and the comps are $500,000, that's a good deal because you have a $200,000 equity. If you're going to look at a modular home park, we're going to look at the rent rate. So this current park, gentleman is charging $390 for 1 stall, 1 unit. The market rate is $550. So having a $160 gap shows, okay, there's a lot of growth and day one equity in the deal. So we're looking off of equity in homes, and on mobile home parks, we're going to look at the gap in rent.
I love that we're getting into the numbers now. What does a good occupancy look like then for a mobile home park? Are you looking for 90, 95%? Because I'm also trying to understand the demographics a little bit, because who is coming into these mobile home parks? How long do they stay? And when do they usually turn over? So give us a little bit of context around what's good occupancy and what kind of demographics you're looking for.
I'm going to take the park that I'm working on right now as an example. So our model is almost like a fix and flip. So we come in, we upgrade the amenities, we're going to fill the park with other homes, and then we're going to sell it. So right now, this park has 60% occupancy. So there's 60 homes already there. There are 40 units that don't have homes on them. So the money that I'm raising, part of it is to purchase 40 homes, modular homes. Then we sell all of them. And once again, we're just going to be collecting the rent on those units. So in the beginning, we're okay with low occupancy because we can bring a lot of value to the park. Increase the rent rates on all of those units, and then we're able to sell at that higher price.
Wow. It's almost as if there are two businesses here, right, Joe? Because you're selling homes, brand new homes to folks, and then you're still renting out the spaces. And is the thought process here behind that as if, hey, you don't have to be maintaining the home because technically the homeowner owns it? And then also, I'm guessing it's a additional plus because they have the pride and dignity of home ownership at the same time. Am I understanding that strategy a little bit better now?
That's like the perfect word. They take pride in their homes more because they own them. So the outside of the property is taken care of more. And average person stays in an apartment for 2 years. Average person that moves into a mobile home park, 14. So once you get your tenants in there, they stay there.
Wow. And I think let me just take some time to really hammer this point home for the audience. Because sometimes we think about our cash flow. Sometimes people post this incorrectly, like, oh, my cash flow is just my rent minus the PITI. But there's all these expenses from operating, utilities, etc., maintenance, but they forget about one of the biggest expense line items, which is vacancy.
Yes.
Vacancy is a huge line item. And when you are moving people in an apartment out every 2 years, that's a big expense number because you got to turn over the units and everything. But here, people are not only staying for 14 years, but sometimes you might not be responsible for the home to turn that over.
Yeah.
What a great business model.
And when you purchase these homes, there's a difference between RV parks and mobile home parks. A mobile home is a modular home that gets designed and worked up in the warehouse. They move it on a big truck and then they set it down. So you can't just like wheel it in and out. And since they own that home, it stays there. They own the home. So if they wanted to pick up their home and move it to another park across town, they could. It's just going to cost them $5,000 to get a truck, pick it up, and move it somewhere else. So that's partially why they stay there so long.
Well, I think when you have high switching costs, what they call it, or high transition cost, then you have a more sticky customer. It's not as if you are just changing cell phone plans, right, from Verizon to AT&T. So I get it. I love these little analogies that we're coming up with, Joe. This is really, really fun. Well, it seems like you got a great project going on. Can you share a little bit about the project? Like, what's your purchase price? What's your renovations, expected expenses, and your expected cash flow for your current deal?
This is like the exciting part, my numbers. So we got this park. It wasn't on the market. So we got it off market and we got it seller finance. A lot of these mobile home parks, the owners used seller finance when they purchased them themselves. So it's very common to be able to get a deal creatively. So purchased it for $2 million, and I'm raising $2 million, and we're also buying it for $2 million. The money that I'm raising for $2 million, $500,000 is for the down payment. And then the seller is carrying $1.5 million, 6% interest only payments for 5 years. Now, the $2 million that I'm raising capital for, I can show you where every dollar is going in, every dollar is going out, and when. So, in a nutshell, $500,000 for the down payment, $1 million is going towards purchasing those 40 modular homes, $425,000 is going to updating the amenities. Updating the amenities, they're like, that's kind of a big number. This helps three things. First, when you update the land, you're increasing the land value, which significantly helps create more equity for our exit strategy. Number two, as we raise rents on the 60 units of the people that already live there, it's easier because they see, oh, they're increasing the value. They're filling the potholes, the landscaping. We put up pavilions and dog parks and barbecues and park benches, solar panel light posts. So we're creating value for the tenants. And number three, it also helps in regards to when we go to sell those 40 homes, when we have someone drive in to potentially be a buyer, they're like, wow, this is a very well-kept community, very welcoming with great amenities. So it helps people that are going to buy, the tenants, and create more equity. So that's where the 425K goes. And then the 75K are for closing costs.
Wow, I really love the business plan and how cohesive the thought process is behind it, because every single dollar that you're spending increases the entire portfolio's value. Maybe if I were just to dive in a little bit deeper, I know because I'm developing, but what for the audience that doesn't understand what you're talking about, when you talk about updating or upgrading the land, what does that mean, Jill? Because that seems like a concept that, am I leveling up? What are you talking about?
I like to keep it simple. So by updating the amenities, when you create more value of the land, so like we're removing the junk, we're creating better landscape. When you go to sell the property, the land value is higher, which just means the equity is higher. So you can sell it for more in the end.
Are you adding utilities at the same time too to more spots, or are other utilities already there in place?
Yeah, we'll need to on the units because we're bringing in 40 homes. So
Got it.
Yeah,
Got it.
Those will increase.
Well, you teed me up so well because we wanted to talk about financing, and somehow you got into this deal on seller financing, and you made it seem as if it's so common and it's so easy. Like all the sellers bought it for seller finance. Maybe you could just give the audience a little bit of an idea, like, hey, what are the options to finance something like this? Knowing that you found a gem with a seller finance.
Okay, this is a good question because now we're going to rewind. And remember when I said I skipped buying single family homes? I started buying mobile home parks. And this was before I started raising capital. These are different investors. This was like when I was getting my feet wet. And I'll tell you how we structured that deal. So we purchased it with cash. We had what's called a private money lender. A private money lender is someone who says, here's $400,000 and I want a 10% return on that $400,000. Then there were two other partners, me and another woman, and I brought $106,000, and I'm what we refer to a private money partner. So I invested $106,000, and this is crazy. The guy hadn't raised rents in 50 years. It's crazy. People are, this is too good to be true. So he was charging $60 a unit. The rent market was $300. So me as a private money partner, I brought money to the table, but I also get equity. Less interest, but equity as long as they hold the park. So we raised the rents. We send out one notice. And we told our tenants, we're raising the rents to $150 in 30 days. Then we said we're raising the rents to $250 in 6 months. This gives them kind of a heads up, and we're gradually building that rent. We are still $50 under market value. Then 6 months from now, which is probably around 4 months, we're going to refinance. We're going to pay the private money partners, and the private money lender back. I'm still a 10% equity partner. So this bad boy cash flows 10 grand a month, which means I get a check for $1,000 and I already have all of my money back. Let's say we hold it for, 10 years. That's $120K in my pocket. Let's say we sell it for $2 million in 10 years. That's another $200K. So $335K for letting my money sit in someone else's account for 12 months.
Wow. What a slam dunk deal. Because I mean, you looked at that deal and you said, hey, I got this big delta right away. So you saw that there was significant opportunity. And then afterwards, you negotiated a structure that one still makes everybody a win-win, where everybody has their own priorities. Some people might prioritize higher interest. Some people might prioritize higher equity. But you designed a structure that made everybody win. It's beautifully done.
Yeah. So I guess going back to your question, we purchased that park with cash. But we had an exit strategy of how we knew we could refinance really quickly, because that rent gap is how we knew it was a good park. And this other one we're doing on seller finance. So there's a down payment, but he's also carrying part of the $1.5 million in the loan.
Well, I think that's helpful for people to understand, right? When you increase rents, actually, I'll let you explain this one. How do you force so much equity into a deal just from raising rents? For people that don't understand net operating income and cap rate, can you just provide a brief highlight on how that works, and how do you just get essentially a deal and put your capital in for 12 months, but forcing a value to refinance to get it all out?
Okay, so remember on that park that I'm currently working on at $390 a month is what they're paying. So if you times that by 60 units, okay, that's a decent number. Now let's take 102 units and times that by $500. Your cash value after expenses currently is $183,000. By year 5, raising rents and selling those homes, it's around $325,000 cash flowing every year.
And then for folks that not following, after you get all of this expenses deducted from your new gross income, quote unquote, that's your net operating income. Divide that by your cap rate, and now that's where your money is made.
So like it will make $580,000 a year, but after expenses, then it cash flows solidly over $300,000 yearly. And remember, we don't have a lot of overhead. We don't have a lot of turnover. People stay in there for 14 years. We just have a couple landscapers and someone watching over the management.
And I think people need to understand, I guess, just from listening to you, Joe, there is a beauty to a simple business plan where you're not trying to do everything, maintain everything, have an on-site property manager that oversees 400 apartments. You guys are renting out the pads after you guys are selling the homes. And now you're keeping your expenses a little bit more predictable, but then lower at the same time. And now that allows you to execute on the plan you set forth to achieve the target net operating income that you guys are looking for. And now I know that these are projected returns. Full disclosure, maybe this is the time to go. We're not soliciting any investments on this podcast. This is not investment advice, but we wanted to give real live examples so that you can, because I like this podcast and doing this conversation with you, Joe, because there's no fluff in this right now. You're sharing real numbers, real projections, and you're sharing exactly all your secrets to achieve the numbers that you're looking to achieve, which is great. Well, Joe, let's get to the point of, for people that aren't as familiar with mobile home parks, we talked about upgrading amenities and getting occupancy. Are there any other like ninja tricks that you know of in the mobile home park space that can get your occupancy rates higher and better resident satisfaction? Any other tricks that you and your team has implemented before?
Okay. Yes, great question, Kent. So this current park, we did test ads. So we put out ads because we want to see how well we're getting people calling. How often are they calling? How many can qualify to purchase the homes? And so we have a full system of, okay, someone shows that they qualify. We have the lender. They can go through us to purchase the home. And so it's a really smooth process. So test runs are a good idea. And when we're comping the area, so big box stores, you want to know where the Walmart is, the Home Depot. We look for potential job openings. How far? This one's 7 minutes from a hospital. So healthcare, education, government positions. So it's doing your research on things outside of the park that is really going to help increase the people that move in there.
Ooh, I love that. And I think sometimes people go so caught up. This is a great one where people say, hey, if you build it, they will come.
No.
No. In this case, Jill is sharing.
That's only a line in a movie. That's not real life, guys. Sometimes movies don't tell the truth.
And I love that because you are showing people how you're not leaving up to fate. You're going out and you're targeting the folks that are likely to enjoy the amenities and enjoy the beautiful park that you guys are creating so that they will want to move in there and get it filled faster, right? Don't forget, you got to fill it in order to achieve the numbers. Otherwise, you are paying debt service every single month, and cash flow is really, really important. Sometimes we put on these pro formas that, hey, this is going to be fully full on day one. How on earth are you going to make it full on day one if you never market it?
Yeah, it's true.
So, Jill, now that we talked a little bit about some of the management, how to market it, are there any potential blind spots that people might not know about in terms of like zoning or tenant rights? Because, here's a good question. If you have a bad person in a park, how do you evict them if they own the home? That might be a really good question. Do you know the answer to that question?
It's kind of based on the situation. If there's a legal situation going on, then we have to get outside sources or like the cops involved. So potentially it's like, okay, other people need to get involved. And we truly try to build the relationships with those that live there so that we can have that kind of communication. And also why we have that manager who's kind of overseeing it. So if we need to address something, we'll go to them directly and be like, hey, looks like your shutters are kind of falling down. Are you okay even if we come in and help put new shutters on? Like, that's going to help ours. How much is it really? Like, how can we give support? Because ultimately we want those people to stay there. And if they're paying rent, awesome. How can we make sure there's looks okay on the outside as well? So going and talking to them directly.
Yeah, and I love that because I think you're already doing the right things to make the park better and ultimately attract a higher level or quality resident, however you might want to phrase it, because you want folks that are pride and happy in the place where they're living. And if they see everybody else taking care of their home, chances are they're going to reciprocate and say, oh, I live in a beautiful neighborhood. I want my home to also look nice as part of the neighborhood. So,
do you have that in regular neighborhoods where that's like, oh, my neighbors kind of got trashed in their yard? Are you going to go ask them to move? Well, probably not. So they're paying rent and it's doing okay, then yeah, we do our best. I did have a good question the other day. Someone had asked, they kind of gave me a hard time being like, I can't believe you're raising rents on these people. And they weren't educated. They're like, these are low income people and you're raising the rents on them. And once again, I explained how we're increasing the value of where these people live. And we understand that affordable housing is in a need right now. And so we could easily come in there and push them all out and be like, hey, we're going to bring an investor and put up townhomes or an apartment complex. And so they're just glad, hey, someone else is coming in, making our community nicer. We can't go anywhere cheaper than where we're located.
And I love that you raised that comment, Jill, because I've received some hate on social media before. And sometimes someone asks me, hey, how do you feel about all these negative comments and stuff like that? And I said, that's okay. Sometimes people just don't understand it. But at the end of the day, how I really deal with it is that I know that my intentions are pure, right? Your intentions have to be pure if you're going in there and you're making the quality of life better for all your residents. And to me, knowing that our intentions are pure is always going to guide us towards the light and overcome any sort of the negativity and hate because, hey, we know what we're doing. We know we're creating a better home. We're not slumlords. I think that's really, sometimes people miss it amongst all the things. Sometimes numbers are numbers, but we ultimately put out a great experience and product for people. And I see that you guys are doing that with this business plan.
Yeah, for sure. It's how people do business. And a lot of these tenants are like not completely surprised when I come in there and I'm like, hey, he hasn't raised rents in 50 years. You guys rode the wave. You knew this was going to happen at some point. And I'm also a single mom that's got to put food on the table, just the way we do business.
And I think when you're providing so much value to a family, Joe, like why can't people make a little bit of money, right? I think about it all the time. I give the analogy. Hey, for something that you use every day, let's just take a cell phone as an example.
Mm-hmm.
Apple makes a profit. Why? Because, well, aren't you using their phone and their ecosystem every single day?
Right.
Well, if that's the case, they're making a profit. For your home, why can't the person that's providing a great home to you make a little bit of money when it's literally where you are a majority of the time of the day?
Yeah.
So that's the analogy I like to kind of bring up to people. And it's like, hey, everybody can eat, everybody can win at the same time.
I like that.
Well,
I'm going to remember that analogy. I like it.
Yeah, that's amazing. I'm so glad that worked. That's the first time I really talked about it on a podcast with a guest.
Yeah.
Well, Jill, help us understand. I want to transition away from mobile home parks now and just into the private money lending space because on this podcast, we have listeners again throughout the entire spectrum of investors, and raising capital is probably one of the hardest tasks that people are faced with. And sometimes, even myself, when I first started, I said, oh, real estate is a rich person's game. I can never do it because I grew up in affordable housing, blah, 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 blah. But from a perspective of a private money lender or a private money partner such as yourself, maybe you can shed some light. How do you evaluate deals that you would personally lend on? Can you shed some expertise on that?
Kent? Yes, I can, because I first became I was a private money lender before I started raising capital. I was like, okay, I got bought out of my pest control company. And I was like, okay, how do people get rich and have their money make them money? Real estate. How do I do that? So my favorite book, at least I started out with, was Who, Not How. It's more about finding the people that know how to do it than how to figure it out. So finding the right people or partners or who to learn from is more important than the deal itself. Because if you find the people that have a track record and they're the ones helping you with your money, you're going to have more success than being like, oh, those look like good numbers, but this is your first deal and you're poor. So when I went into this, I was like, okay, game plan, find the person who's best at what they do and see if I can partner with them. And so it depends if you're getting equity in a park or if you're just a private money lender. I'm going to give you two key things. Everybody's got to listen. Don't forget. Loan to own. Don't lend on a deal if you're not willing to own it if the deal goes south. So let's just take a fix and flip, for example. Let's say I'm lending $100,000. Here's the second thing. Holding more collateral than your loan is worth. Okay, you have a fix and flip. Well, I don't know how to underwrite. I don't really know if it's that great of a deal. But if I can hold hostage your two houses that are cash flowing, if your fix and flip flops, I just basically inherit your two cash flowing properties. So my collateral is worth more than my loan. And that has been an approach that's worked for me. There's more than one way, because I don't want to learn how to underwrite and all of those details. I want to stay focused on what I'm good at during the day and my day-to-day job, and just have my money making me money. So it's finding more of the right people and the partners that know what they're doing.
Wow. I love your principles because they're so simple, but then at the same time, they're very protective and they make sure everybody's interests are aligned, right? Because if you are holding collateral on something that's providing cash flow, then you're protected. But then the person that's borrowing from you is incentivized. Hey, I better make this work. Otherwise, I'm going to lose something here that's of meaning and value. Wow. I love that. I love those principles. Is that almost the same criteria that you use to determine what to lend on? Like, do you care about cash on cash return? Do you care about the interest rates? What does that look like for you in terms of criteria and what you will want for a return on your capital?
Personally, for me, I have someone who's my middleman, my negotiator, and he gets a piece of the pie. I would rather get my money back and know that it's working for me than get a high return on something that's like more risky. That's just my risk tolerance. Remember, single mom over here, as long as I'm making double than I would in a CD, great. And then I stepped up from there and I was like, that's when I realized, I want to create generational wealth. How do I build wealth? And that's having equity in deals. So private money lending, you're going to get hit with taxes because you're just getting higher returns. But if you get a lower return, but equity, you have tax advantages.
Yep. And sometimes the depreciation makes you more money because you're in a different situation compared to other investors who might not have as much income to write off. And I love that that is a criteria for you, because now that shows that you really are looking at the holistic picture. You're not just looking at straight up cash and cash percentage or interest rates. You're looking at, hey, if I own this deal, I can write off some stuff and I might come out ahead had I try to prioritize at 2 extra percentage points on the interest rate. That's a great perspective on that piece.
It's not just how much you make, but how much can you save?
That's so good. And well, Joe, you mentioned a book, Who, Not How. Maybe this is a good time to ask this question. What sort of traits or evidence or track record do you typically take into consideration before you ever decide to invest or lend on a deal?
Are they doing this with their own money? Do they believe in the concept well enough to put their money where their mouth is? And so it's someone who has a track record. Also, people that I can connect with that have done deals with them. And can they offer that collateral? Because that's really what it comes down to is, hey, my collateral is worth more than my loan. Another thing is structuring the time frame of when they give you your money. So here's an example. Let's take a fix and flip. I say, hey, you can hold on to my money for 3 months at 13% return. Okay, if you hold it for 14 months, it's 14%. You hold it for 5 months, it's 15%. From there, you have 1 month of extremely high late fees. And then by 6 months, I take over my collateral. And with a fix and flip model, it's really hard to say August 1st, I'll have everything done. Because what if your contractor doesn't show up? What if cabinets are taking longer to get here? So giving them that large buffer helps them, but I'm also getting a higher return on my loan.
That's really cool. And in terms of track record, how many deals do you typically look for people to have done? Like, that's sometimes we say track record, but it's interesting just to kind of hear different people's perspective. Like, what does a track record mean? Is it first deal, fifth deal? What does that look like for you?
It depends on the type of deal and how much money they're asking for. So if it's only $30,000 for 30 days, their experience doesn't need to be as high as my $250,000 deal at 2 years. So kind of comes down to numbers and deals.
No, I love that you shared some examples because sometimes we hear people and a lot of people ask this question, especially in the subject community, like, how do I structure this? Like, this is such a common question. And sometimes I just tell people, well, why don't you just ask other people what they want? Right? Sometimes we forget the most basic and fundamental question of communication. It's just ask them what they want. And then you decide whether or not that's something that you want to take on. And I loved your story about taking equity. And I mean, for me, my first deal, I put in $200,000 of my own money and my partner put $50,000, but we were 50-50 partners, right? Way more risk because I wanted to show my partner I wanted to have skin in the game. And also just thank him for supporting because it was our first deal. And he's like, we have no idea what we're doing. But he took the ride with me and he said, hey, we're just going to learn along the way. Yeah, we hit big on the first deal, but in the second deal, it flipped. Second deal, they put in 200 grand. I put in $80,000 and we're 50-50. Right. And that's why I give advice to folks. Hey, for your first deal or first couple of deals, it's more about building a relationship and having a story to say, hey, I was willing to risk and put my money where my mouth is for the deal. And I think that really speaks volumes to how you evaluate deals because how else do you know you can trust them? And how do you know that their interests are aligned with you as a lender?
Yeah. And as someone who also raises capital, I was training someone yesterday and he's like, how do I get people to trust me as I'm raising capital? Like we can switch a little here because it's like, how do I trust the person? Now it's like, okay, how do I get someone to give me their money? And he has one mobile home park. And so I'm like leveraging other people's credibility. So for him, I was like, you already have a credible track record because you have the proof of concept and you can show them, hey, look, this is what I've done and this is how I've been successful. And his is also cash flowing $10,000. And okay, let's say you don't have a track record. Just like you said, Kent, partnering with someone who potentially does, or they're bringing money as well. So it's like the reason I took this position as the chief investment officer for this fund was because of the team and what they brought to the table. And I vetted them more than the structure of how they do things. I'm like, what's your track record? Okay, now as I raise capital, I'm leveraging their experience, their track record, how they have things structured, the attorneys they use. So when you're doing anything, it's like, find the person who's best at it and then ask them, how did you set it up? So then when you go to that person, be like, I'm setting it up exactly like Pace Morby. I'm setting it exactly up like Kent or Jill. They're the ones that taught me how to set it up.
I love that. And then that's where you have evidence or third-party support is how I would call it. That somebody else did it the same way and they were successful in executing on that plan with that structure. And I love how you said you found a team to plug yourself in. And I think that's so important for everybody listening right now. You don't have to be a capital raiser. You don't have to be the operator. You don't have to be the closer, right? Yeah. There's different positions within each team that you can structure, you can plug yourself into. And at the same time, then that's where your strengths come out. In this scenario, Jill, you're the capital raiser. You're so great at pitching and you're so great at building relationships that a team that brings you on it's like rocket fuel for them because they're just going to keep on growing. They're going to raise so many millions and millions of dollars.
I love that book. And so the next book, so the same people that wrote Who Not How wrote a book called 10X is Easier Than 2X. And it's like, if everyone on your team can stay in their lane and just like sharpen their skills, then that's how you really grow. Because if I learn how to underwrite and if I learn how to call sellers, guess what? I'm going to start doing a little bit of all of it. And I'm going to cross over and be like, you should do it like this. You should do it like this, where it's like, I'm going to let them focus on their one thing. People are like, how do you underwrite a deal? I'm like, I'll send you to my partner because he's really good at it.
I love that. And I think that's how people can take away. And I really hope people come away from this just understanding that you got to understand yourself, be really self-aware, And the question I've been asking everyone, Joe, is, hey, what gives you energy? That's so important because that's how you stay motivated to keep doing the consistent thing day in and day out, even when it might be boring one day, but you know it still gives you energy. For you and I, we talk with investors and other students and other community members every single day. But that gives us energy. I love talking. I know people that says, oh, if I talk to 5 people, I got to go lay down. I'm not going to talk to anybody anymore. And that's okay, right? That's okay. Yeah. There's another position for you if you don't want to do that. And I think that's why it's so important for you to find your own team that complements your skills, just like what Jill has done. And now she's just getting access to these slam dunk deals.
It's about getting the right people on the bus and then figuring out where they need to sit.
Joe, you have been so amazing on this podcast, and the energy and the charisma. It's been wonderful to talk to you today, Joe. I'm really grateful and really blessed. And Joe, maybe I'll ask you this question, because this is a question I typically ask everybody.
Okay.
Why do you think affordable housing, particularly the lack of supply of affordable housing, is so hard to solve for?
People like to make money. And putting up more townhomes is, first, you're going to get the government or the town's going to be more okay zoning for someone that will pay $4,000 in taxes on their house over a modular home. They're only going to get $200. So the city's like, hey, I'd rather this developer put up a bunch of townhomes. But on the flip side, there is a long list of people trying to get on the affordable housing, being like, a single mom with a disabled child is like, I'm in dire need of some help. So there's a high demand and they're not letting someone come in and help solve the problem. So we really pride in making it a win for the community, people who are really in need of affordable housing, and also making it a very lucrative passive income for investors.
Joe, thank you so much for that answer. I love getting another piece of the puzzle to solve this puzzle of solving this affordable housing problem. But I really want to thank you, not only for coming onto the podcast, but for everything that you and your team does. Because seriously, without people like you and your team, I would have never had the home I grew up in. And I can't imagine what life would have been like for my mom had she never had that apartment. And I can't imagine where I would be today had I never had that apartment growing up. So I really appreciate folks like you putting out a great product, building beautiful homes so that people can have pride and dignity where they live. So thank you so much, Joe, for coming on. And I can't wait to have you come back on the podcast and just tell us all about your deals next time.
Yeah, it's been an honor being here. The energy, it went by quickly, too fast. So we're going to have to do a take 2. And yeah, I appreciate you just being vulnerable and putting yourself out there. Like, do you know what number of podcasts this is for you?
This is number 73, I believe.
Okay. Yeah. Do you want to hear a statistic? 30 seconds, close this off.
Yeah, tell me.
3.9 million people start a podcast every year. 20% make it past episode 3, and 1% make it past 20. So Kent is in the elite 1% group. Just saying, just so your listeners know how awesome Kent really is.
Joe, thank you so much for that. That's so crazy that that's a stat, because literally, I think I told you this before. After month 2, I thought about quitting. And I understand, because I had 17 views the first month and less than 100 views the second month. And I'm pretty sure, like I told you, it was probably my mom, who doesn't even speak English, and my wife who was watching it. So, Joe, I'm so grateful that you came on, and I'm so glad you came on and shared so many gems and tactical advice nonetheless. Well, Joe, if people want to reach out to you and find out more about you, where can they contact you, and where can they find out more about your deals?
Great. You can go to sonoscapital.com. You can also find me you can send me an email at jill@sonoscapital.com. And I'll even throw my phone number out there. So 385-424-5230. So I am an open book and happy to connect with anyone.
All right. Should people follow you on social media as well?
Yes, the Jill Jensen on both Facebook and Instagram.
All right. Make sure everybody that you're listening to this right now, follow Jill. She is putting out amazing content, especially about mobile home parks. I've been following her and watching her content. So, Jill, thank you so much for coming on. We can't wait to have you back again. And we are out.